Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make you a little bit of money. My job is not just to entertain, but to do some teaching. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Wall Street has concluded that companies involved in artificial intelligence are paying too much money to build out the data centers. The hundreds of billions of dollars that they're all spending has turned off money managers and driven them toward other tech companies or even other growth companies from different sectors, including industrials, drugs, anything that has nothing to do with data. In fact, the data center is now a scarlet letter, and Wall Street loves industrials that have zero contact with these money pits. And that's the setup for today, where the Dow dipped 302 points, S&P declined 0.24%, but the Nasdaq advanced 0.23%. Honestly, it does seem pretty hopeless for the data center stocks. Consider 4 out of the 5 top performers in S&P 500 this year are tech. But listen to this kind of tech. SanDisk, Western Digital, Seagate, Micron. Why these? Because they're plain old-fashioned data storage companies with an immense amount of demand and not nearly enough supply. And the storage companies are inherently boom and then bust. Always have been, always will. Right now, there's not enough capital equipment to relieve the tightness in the market, so these companies can put through endless price increases. But the moment there are enough machines to manufacture these products, their stocks will indeed plummet, as they always do. Micron reports after the close tomorrow night, and while it is one of my absolute favorite stocks, and I think it'll have an amazing quarter, there will be analysts who try to call a top.
The House of Pain.
But how about the rest of tech? The data center, the hyperscalers, the proprietary semis, the ones we loved for so long. What happens to those? The answer can't be found here in a trading desk. Not in this room. The answer can arguably be found in the greatest movie of all time. The answer can be found in The Godfather. You don't hear about it much on business shows, but then again, how many one-man business shows are there? How is The Godfather relevant here? Right now, you got 5 big tech companies, 5 families, so to speak: Amazon, Microsoft, Google, Meta, and OpenAI in partnership with Oracle. They're going all out to build these data centers anywhere they can. They're even in space. They're each trying to outspend the competition, if not dominate everything, then at least to keep rivals for snapping up their own core businesses. Meta, which many people feel has actually fallen behind, is trying to protect its social turf. Amazon's trying to block out anyone from doing retail. Microsoft wants to block companies that might intrude on both their lucrative consumer and business applications. Nobody wants to come in against Windows because they know they'll be crushed, though. And OpenAI, they want to come after everybody. With a budget of at least $300 billion for Oracle alone and many other commitments made to many other companies totaling a whopping $1.4 trillion. This reckless, imprudent data center spending has been collapsing the value of all the stocks. Many have tried to rein them in, but to no avail. A lot of that's because OpenAI is funded by venture capitalists. The company seems to be willing to spend itself to death. The strategy is almost suicidal, but they're private. I have good news, though, for the heavy hitters in AI, which brings me to The Godfather. In the movie, Don Corleone agrees to a peace with the other 5 families to end the war that killed his hot-headed son, Sonny Corleone. Now that the toll bridge scene, that one from Jones Beach, it's really something else, even if it was really shot in an abandoned aircraft field. Now, in my version of what's going to happen here, right now, Oracle and OpenAI, they represent the renegades here, with a show of force that's totally unnecessary. In fact, OpenAI CEO Sam Altman, he kind of reminds me of Sonny Corleone, because he's too impetuous to lead the family. He's using Oracle on a $300 billion power play to outspend everyone else and take on all comers. Sam has perhaps $50 billion in the bank. He arguably needs about 25 times that to make his dreams come true. Domination dreams. I don't know. Okay, that's the bad news, because as long as Altman's spending like crazy, everyone else has to spend to keep up with him. But there's something lurking here that could end the war and allow these stocks to come back to life. And it's called discipline. In September, Oracle raised $18 billion in the bond market, okay? Their bond issuance has drawn scrutiny in the form of aggressive buying of credit default swaps, What does that mean? It's basically insurance that pays off if the company defaults on its obligations. Oracle. Except you don't need to be a bondholder to buy these insurance policies. These people are betting against Oracle itself because of the stupid amount of money that it's spending. Oracle already has a huge amount of debt. Their balance sheet's not that good. At some point, they'll heed the warning of the bond market and slow things down, or else. And they don't want the or else. These data centers cost a fortune, and even the best builder stumbles. We saw when, I don't know if you saw the story of CoreWeave today. Oracle can't risk blowing up its balance sheet for Sam Altman. That's when and how we're going to get out of this morass. Oracle blinks. Once Oracle shows discipline, and it must because the bond market is a cruel taskmaster, that's when Sonny gets shot up at the toll bridge and Don Corleone calls the disputing families together and says, this must all end. And it does. Now, we live in a country where companies aren't supposed to collude or fix prices. I get that. But if Oracle starts showing discipline, I think every other hyperscaler, the families, would slow down and we get a more reasonable pace. It would be one of these things where you would barely notice all the spending. Rationality would return, and we wouldn't be reopening 3 Mile Island or trying to build some small nuclear power plants that may not work because we're just that desperate for electricity. This way, Oracle stays alive, and OpenAI is forced to choose which businesses it truly wants to target, because he who defends everything defends nothing. Frederick the Great. Now, you may think that the 5-family truce would be bad news for the big data centers, but you would think wrong when it comes to Broadcom or NVIDIA. Both will get plenty of business. The truth is, it was never feasible to build all these data centers that are needed. That's why everyone hates the stocks. It's exactly why these two stocks keep going down. Not until Oracle blinks, and it will. And given how its debt is trading, they have to. Will we feel really good about owning anything connected to the data center for a run? Let's face it, anyone who has the fanciful build-out baked into their numbers right now is overestimating themselves. But here's the bottom line. Listen to me. I'm not saying it won't be rocky. I am saying that it will end better for OpenAI and Oracle than it did for Sonny Corleone. And the truce that follows will allow everyone to skate in their own lanes, cut their CapEx budgets, make a huge amount of money, and then see their stocks really fly. Meta, Microsoft, to the moon. But things could get uglier first without that 5-family truce that must be called by Oracle in conjunction with the perpetually sunny OpenAI, or we're still going to go lower. Kathy in California. Kathy.
Booyah, Professor Cramer. This is Kathy from Walnut Creek, California.
Thank you.
Second-time caller, active club member for 20 years. My question to you is on TJX. Year to date, the stock is up 29%. And before I start a position, should I wait for a pullback or buy now?
I want you to wait for a pullback. It just actually did a kind of a pirouette today. It spiked up and then came down. That's usually a sign that it's going to go down tomorrow, the next day, and perhaps even next week. And that's when you'll pull the trigger. It's a great situation. We're going to Brian in Illinois. Brian.
Jim, it is a pleasure to speak with you. I wanted to start by saying that I used to subscribe to the Motley Fool, and I lost a lot of money. But then I started watching you about a year ago, and that's changed. And just about a little over a month ago, I bought your book, and I take you on my weekly audiobook. I take you on my weekly jogs.
Oh, thank you.
And I love it.
Thank you.
And as of last week, I am now part of the investing club. So
yes, I love it. We had a good meeting last week. Me and Jeff Morris.
Yeah.
How can I help you?
So yes, I've read that you have some positive sentiment regarding this stock, and I've purchased a sizable portion of it, and it's I bought it at kind of its peak, and now I'm kind of at a break-even point, so I can get out. And I know from your November meeting that you said that's not your typical strategy, but
what stock is it? What stock is it?
It is DraftKings, and I want to. Okay,
DraftKings is down on stock right now just because it's had some highly unusual losses, but those are going to end into the statistics favor them coming back to even when it comes to those losses, and I think DraftKings is a very well-run company, and I think the industry's in consolidation, and I like it very much. Okay, I'm hoping that there'll be a truce among the AI5 families. But that's only going to work out if Oracle and OpenAI blink, or they have a kind of Sonny Corleone resolution. Oh, man, we've got another big data dump following the end of the government shutdown. I think this stuff is important enough that it deserves some extra attention. I certainly didn't do it at the top. I'll reveal my takeaways. Then, the real pain in this market is in the commodity market, especially in oil. So I'm going off the charts to get a technical read on where things stand. And Texas is one of the fastest growing economies in the country. So I'm sitting down with the CEO of Texas Capital, get a better sense of what businesses are really doing with their money in the Lone Star State and whether you should be into the bank itself. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.